first thing that the hot money does is it just gets the hell out of what it's in and gets into dollars, because that is safety. That is perceived to be safety. That's always the first thing that happens.
Welcome back to Soar Financially. Thank you so much for joining us here on this channel where we discuss the macro to understand the micro better. My name is Kai Hoffman. I'm the @JR Mining Guy on Twitter and the CEO of the Soar Financial Group. And I'm really looking forward to this conversation today. It's with a good friend of the podcast here. It's with Alasdair Macleod. He's the head of research over at Goldmoney, and we have lots to catch up on. I think it feels like things are spiraling a bit out of control in the financial market side. Bond yields are exploding. The dollar is extremely strong, and gold is tanking. We were trying to make a bit of sense of it and put it all into context. But before I switch over to my guest, hit that subscribe button real quick, because I know 80 to 85% of you are not subscribed to this channel. Let's change that. I'd love to chat with Alasdair more often. I'd love to bring other great guests of great caliber on this channel as well. Your support really, really helps with that. Now, Alasdair, it's great to see you again. Thank you so much for joining me here again on Soar Financially.
Thank you very much for asking me, Kai.
Absolutely. Yeah. Last time we spoke was in Frankfurt in person, I believe. That was at the end of May. Yeah. So quite a bit has happened actually since then. Let's take a look at the last, what is it now? It's October 3rd as we're recording this. So it's already 4.5 months now. But I mentioned it in the intro. Bond yields are spiraling out of control. The dollar is gaining strength again. Recap the last 3 months for us, would you?
Yeah. Well, I mean, for a long time, I've been saying that, we're facing a credit crunch because of contracting bank credit. And yeah, that's sort of happened. And the other thing that goes along with it is that as you get contracting credit, what it tends to do is spark demand for credit, because contracting credit basically means that the banks are frightened of extending their obligations, and they want to withdraw their obligations. And inevitably, this comes at a time when sales might be slowing down for the average company. Their input costs are rising, and so they need more cash, if you like, to bridge the gap. So they go to the banks and say, please lend us some more money. And the banks say, no. Well, they say, well, we'll lend you half of what you ask for, but it's going to be at a higher rate. And so this is actually what happens. I mean, people just don't seem to realize that when the banks actually start withdrawing credit from the economy, interest rates rise. People associate a slowdown in money supply with, they think, oh, it's recession, which means that interest rates are going to fall. No, not at all. It doesn't work like that. I mean, eventually it might work like that, but certainly not to begin with. So that's what we've seen, Kai. We've seen things slow down. A lot of risk is emerging in markets. A lot of risk is emerging in credit, and therefore the lending by the banks. So, that's continuing. And I think particularly in the last 3 months, Russia and Saudi Arabia have tightened the screws on us by cutting off oil supplies by a further 1.3 million barrels a day. And that's had the effect already of driving up oil prices to over $90. I mean, as we speak today, it's a little bit under that. But I think there's very little doubt that it's going higher. And I think JP Morgan are forecasting $150 price for oil. And more importantly, for those of us in Europe, anyway, what the Russians are doing is they're putting the squeeze on heating oil and diesel. Diesel is virtually the same as heating oil. It's just a sort of more refined version of the same thing. So those prices are rising. And in the last quarter or so, they've risen by over 40%. So that is going to start impacting on virtually everything, because 95% of logistics in Europe is diesel driven. So that's going to affect virtually everything. Some food prices are also rising, though others with a more seasonal bent, such as wheat, have actually been falling. But you can see the direction in which prices generally are going. There's a lot of pressure for higher prices, and they are realized as higher prices when our beloved central banks make the credit available for us to buy these goods without having to choose between this and that. We can buy everything so long as we got credit in order to be able to do it, a credit card, whatever. So the result is that prices are rising, and this is going to make the winter extremely difficult. I think that it's not all plain sailing as far as the Russians are concerned, in particular, because the history of the performance of the ruble has been that higher energy prices actually don't support the ruble. I mean, if anything, it's the reverse. If you create a crisis in fiat currency land, then people go to the dollar. And that's exactly what we're seeing at the moment. I mean, people are buying the dollar because everywhere else looks really pretty awful. So that's why they're doing it. Now, I think the big news, and this has really surprised everyone, it hasn't surprised me. It's just the velocity with which it's going, I think, has been a slight surprise, but it's telling us something. When you look at the 10-year US Treasury bond yield, it's the highest it's been since 2007. And looking at my screen, it's 4.72%. What's interesting is that last month, the Fed came out with really a dovish approach to interest rates. They turned around and said, well, we're not going to increase it this time. And as you would expect, they said, well, this inflation fight isn't over. We may have to increase it later on or later on. Now, what's surprising is that you would have thought that that the yields on US Treasuries would have softened in the wake of that. But no, they soared. So what does that tell us? Well, I think the problem with it really is that it's indicating that there is a crisis in collateral. This is terribly important because virtually every financial deal involving derivatives and leverage and all the rest of it, you require to post collateral, and that collateral can be cash. Very often it can be bonds. If you look at it this way, the rise in yields on the US Treasury since around about 2020, when it bottomed out, has basically undermined the value of a 10-year Treasury by something like 30%. So, what does this mean? It means that the collateral value has gone down, so you've got to go and top it up. And so what do you do? How do you top it up? Well, the answer basically is you've got to liquidate something in order to put more cash in as collateral. And this is what is now driving bond yields in the US. And it's also undermining bond yields elsewhere, where there is the same problem. I mean, the Eurozone, for example, if you look at the chart for the German 10-year Bund, which you'll be very familiar with, I mean, that again is soaring into new high ground, admittedly at a lower level than US Treasuries, but then hasn't it always been at a lower level than US Treasuries? And look at what's going on in the yen. I mean, it's just staggering, the incompetence of the Bank of Japan. I mean, they came out, I read some sort of statement from the Bank of Japan that they were holding on to 0.5% negative rates in the fight against inflation. What? I mean, I couldn't believe it. I read, perhaps I misread it completely, but that seems to be their overall approach. They seem to think that minus 0.5% interest rates, is sufficient to fight inflation. And they are fighting a losing battle. I mean, at this moment, if I look at the Forex rate for the yen, it's just about to break through. It's standing at 149.912, just about to break through into new high ground above 150 to the dollar. Of course, a high number is a weak yen, so it's slightly confusing in that way. So you've got to look at it upside down. And the result is that much excitement in the gold bug world, because they say, look at the soaring price of gold in yen. Yeah, sure. I think the Japanese haven't missed that one either. So these are the things that's going on, and I think the point about collateral is actually very, very important, because we had an example of this in the UK when Liz Truss was Prime Minister, very briefly, 44 days. She and her Chancellor produced a budget which ended up with her having to leave. But what it did was it created a crisis in the pension funds. Now, unbeknown to us all, the pension funds we're trying to respond to zero or close to zero interest rates and very low bond yield rates by leveraging up their bond investments, their portfolio investments, with a sort of, if you like, can't remember what it's called now, but it was a leverage which required them to post collateral when the bond values started falling. And what happened? We had an absolute panic. I mean, bond prices absolutely collapsed on this until the Bank of England stepped in and bought £68 billion worth of gilts and supported the market. And at that point, the panic subsided. So something like that has probably got to be done by the Fed. But I think the Fed at the moment is still keeping its fingers crossed and hoping that this problem will go away. Anyway, that's an update, and that's where we are now.
No, it's a quite comprehensive update, Alasdair. Appreciate that intro. Because I wrote down some things I want to follow up with you on. As I said, last time we spoke was at the end of May, and the BRICS meeting happened. You mentioned Russia and Saudi Arabia, obviously, as part of the OPEC and OPEC Plus sort of situation, and how they see themselves as the new world central bankers. But curious, like what the situation is, like what came out of the BRICS meeting. Is there anything of interest to note? Because before then, it was quite a bit of hype, especially in the gold community, that there might be a new currency introduced.
Yeah, well, I mean, we were actually told by the Russians, and we were told by Lavrov even in January last, that a new trade settlement currency would be on the agenda. I mean, the way he put it is that we can't keep on taking in rupees, which to us are completely worthless because they can't trade them out. Then you had the statement via RT, which obviously was officially sanctioned, that a new gold-backed trade settlement currency would be on the agenda. It wasn't on the agenda at the end of the day, and I think the reasons for that are really quite simple. India and China thought it was it was too soon to do something like that. In the case of India is effectively Keynesian in its approach. Just to give you a clue, the Bank of England has been, for a long time, the sort of chief advisor, if you like, to the Reserve Bank of India when it comes to appointing its governor. These are Bank of England appointees. So you can see that, the mess we make of things is being, to some extent, being replicated in India. So India was certainly not ready for this, and is not attuned to the sound money argument. They're more attuned to the sort of Keynesian stimulation, and they need to have the room to be able to do that, and so on and so forth. And of course, the result is that the currency is, paper rubbish. China has a different approach to the Russians. The Russians, as far as they're concerned, they're fighting a war in the Ukraine. They need to stabilize their currency. They just want to get on with it and do it. And that was their plan B. I mean, as far as they were concerned, the new BRICS currency was a plan A, and that would then be followed by them introducing a gold standard for the ruble. But China takes the long view. I mean, she says, well, we've been around for 2,500 years, or is it more since Confucius was around, who we still respect? I mean, you want to find the Chinese spies around the world, just go to the Confucius Institute. So, they've been around a long time. They don't do things in a hurry. And, the sort of Sun Tzu approach is let everybody else make the mistakes, and then we will consider our position. And that's basically what they're doing. So it was a bit premature as far as Russia was concerned, I think, to introduce this. But they managed to get some new members into BRICS, which was good. And not only that, but Russia will assume the presidency of BRICS in January. So I think we can expect further moves on this front in the new year. So that's roughly where the BRICS story, I think, started and ended. It hasn't, obviously it's going to evolve. My view is that the Shanghai Cooperation Organization, virtually everybody involved with the Shanghai Cooperation Organization attended the Johannesburg summit. So I think that there is a vague plan in the background to merge the two entities. And that would make an awful lot of sense, because that's, sort of rather like NATO, protects its members. That would, ensure that everybody is sort of doing the same thing, all, it's a complete alliance and so on and so forth. And it just makes it a bit harder for us in the West to attack what's now being called the Global South, which is essentially, the wider Asian, African, and South American sort of BRICS, Shanghai Cooperation Organization entity, which is now, it's something like 64% of global GDP, and I don't know, 70% of the world's population. We're small players now in all this. We may be very powerful players, and we may be up our own backsides in terms of our own importance. But, the fact is there is a far bigger world out there evolving, and we're going to have to live with it.
Now, and that's why I love chatting with you, Alasdair, because you managed to zoom out, despite me being in the US right now. Actually, as we're recording this, you zoom out. You have the geopolitics, like the overall global scenario, or you put it in better context than many of the other market commentators, I think. So it's a big benefit of having you on the program. But another point I wanted to follow up with you on is the strength of the US dollar, and maybe also in comparison to gold, because you said, well, it's the cleanest shirt in the hamper in terms of currencies. But it seems like a lot of people are just fleeing into the US dollar. And I'm trying to figure out why. Because mid-July, it bottomed at like 99.8 or so, the DEUTSCHE, that is. And now we're looking at 107. That's a straight move higher, and a strong move higher. Like, can you elaborate on that? And what are some of the factors you see since mid-July there?
Sure. It is creating a lot of problems for all other currencies, really. Like huge problems in some cases. So this is very important. If you look at the run-up to any crisis in our fiat currency world, the first thing that the hot money does is it just gets the hell out of what it's in and gets into dollars, because that is safety. That is perceived to be safety. That's always the first thing that happens. Then there's a sort of second thing that happens. You get the crisis. We see rising interest rates. I have no doubt that this is creating problems in the commercial property scene. With loans are going to be defaulting. You've got bonds on bank balance sheets in America, which they reckon are something like almost, coming towards $1 trillion of losses now, et cetera, et cetera, et cetera. So there is a crisis. Now, when people begin to recognize the crisis, is at that stage that they get out of the dollar and get into gold. And you see this very, very clearly if you look at what the gold price did over the course of the 2007 to 2012 period. Ahead of the Lehman crisis, gold peaked at around about $1,000. It started coming off as the property crisis was beginning to unwind. And then when Lehman finally fell, its first reaction was to fall a bit further. And I think it got down to something like $680, something like that. And then from there, it soared. And it soared so that by September 2011, it was trading at over 1920. So, this is what we're seeing today. What I'm trying to say is that this is perfectly normal. We have a situation where initially people fly into fiat currency, the number one fiat currency, the king of fiat currencies, which is the dollar. And then when the crisis hits, they realize that actually where they should be is in gold. In other words, out of credit. You've got to get out of credit. When the crisis hits, just get out of credit. So it's a two-step thing. So, we've had a very, very sharp sell-off in gold, which, of course, has got all the gold bugs, throwing their hands up in the air and thinking, oh, it's the end of the world, or, what's going on? Or I should be invested in US treasuries, not gold, and all the rest of it. Yeah, fine. But, they don't actually realize that this is a 1-2 knockout sort of boxing match, if you like. And I have no doubt at all that we will see gold rally extremely sharply from current levels, because it's not that gold is going up, Kai. It is that the fiat currencies, in terms of their purchasing power, are going down. And where that is measured in commodities, the representative of all those commodities, including energy, which we're already seeing go up, is, of course, gold. So gold, I'm not factoring any increase in the purchasing power of gold in at this stage. That, I think, happens later on. But for the moment, what we have loss of purchasing power of fiat currencies. That is going to accelerate. And when people begin to realize that that is what is happening, then they're going to get out. And in the case of the dollar, I mean, we're looking at the end of a fiat currency era, and that has been going now for 52 years, since 1971, when it was pure fiat. I mean, it was sort of quasi-fiat before that by very, very limited convertibility, only accessible to central banks and people like the IMF and so on and so forth. So this is the end of a very long process, during which time an awful lot of dollar credit has been produced. Now, foreigners have something like, and this is according to the US Treasury's own tick figures, they have something like $32 trillion worth of long and short-term financial assets, including deposits, which I think run at about $6.5 trillion, deposits in the banking system. But that's not all. In addition to that, you've got eurodollars. Now, the eurodollar content has been very, very hard to quantify, but the Bank of International Settlements, their chief guy, Claudio Borio, produced a paper, I think month or two back, which estimated what this is. Now, he was looking purely at offshore dollar obligations, particularly in the currency markets. But this essentially is what eurodollars are. If you create credit outside the US banking system, it's very often part of a currency transaction. So, it was giving us the numbers. And on top of that, of course, you've got Eurobonds. Now, the Eurobond market is relatively small. I mean, we're aware of it. It's about $10 trillion. 10.7, I think, was the last figure we had. But looking at that underlying credit, which has been mounting since the Second World War, we're now at $93 trillion. Now, this is huge compared with the official figures, which, of course, if we care to look at US Treasury ticks figures, we think, the foreigners have got 32 trillion, they need it. They've got to hold on to it. No, they don't. That's the first thing, because when you get falling financial asset values, they're not going to hang around to take the losses. Believe you me, they're going to get out. On top of that, they've got all these euro dollars, which is absolutely massive and has to be liquidated. So I think we're seeing this. We're beginning to see this with the difficulties in the collateralization market, which I've just referred to, which is reflected in US Treasuries. I was also interested to see that there is an ETF of US utilities. Now, US utilities are, if you like, the equity equivalent of collateral. Because you've got a stability, you've got a sort of a yield. Usually you've got a yield under it as well, which is getting rare in American markets. But that, if you like, if you want to use some sort of equity as collateral against something, that's probably where you go. And, that's started falling quite rapidly. So that is echoing what's going on in the US Treasury market. So this is a very serious crisis, and I don't think it should be underestimated. I suspect that it will drive US, maybe the yield on the US 10-year. I mean, it could easily go through 5% very, very shortly. Now, standing back from that, if we're looking at the end of the fiat currency regime, then what we're looking at is the sort of currency instability which we experienced when it started after the Nixon shock in 1971. And in those days, sterling was very, very vulnerable, got very badly hit. And there were times when the Bank of England had to raise interest rates to 15, 16%, 17% in order to get, government funding completed. And that's why in those years we had three gilts, which are UK government bonds, with coupons of 15%, 15.25%, and 15.5%. I mean, just imagine what the situation is likely to be for the US Treasury's funding program as that sort of weakness begins to enter into the picture for the dollar. We already have, we've just completed a fiscal year which ended at, end of September, and we're recording this on October the 3rd. So at the start of this new fiscal year, what's the interest cost going to be? I wouldn't be surprised to see it cross 1.5 trillion in this fiscal year. What's the deficit likely to be, including that? I would be, I suppose, surprised if they managed to keep it below 3.5 trillion. It's not just, Bidenomics and so on and so forth. It's also the problem of interest, which I've mentioned. But particularly with the US economy slowing down and threatening to stagnate at very, very best, slump at worst, then, things like mandated welfare costs and all the rest of it are going to soar while tax income drops. So we could easily see a deficit of as much as 8 or 9% of GDP, not GDP, of government spending. And that is massive. And that gives the whole of the dollar scene an extra inflationary impetus, as any monetarist will tell you. But markets don't necessarily wait for a monetarist, response. They will look at the deteriorating situation and anticipate it. So I just see an awful lot of trouble for the dollar, and I think that the idea that we'll probably look back on this crisis, the collateral crisis, with 5% yields on the 10-year rather fondly. Because we will be living with far, far higher rates. I think that's the whole key to this, Kai. It's not something I wish or whatever. But as to a point, I think a lot of people, misunderstand the relationship between interest rates and gold. They seem to think that gold has got to have the same sort of interest rate as fiat currencies, and if it gets too stretched, then the opportunity cost of being out of fiat currencies is going to impact on the gold price. I mean, that is probably true when you don't have anything like a financial crisis. But when you've got a deteriorating situation, then it's very, very different. And I would point out that in the 1970s, we went into that era with the Fed funds rate at around about, I think it was 6.25%, round about that, and the price of gold at $35. We came out of it with the Fed funds rate at 19.5% and the price of gold hitting $850. So the idea that higher interest rates are bad for the dollar, no, forget it. It's all part and parcel of the deterioration of the purchasing power of fiat currencies. And as soon as people actually begin to realize that, that gold begins to reflect the fear of the loss of purchasing power of a fiat currency. And that's what we had in the 1970s. We will get it again from here. I mean, I don't actually care, and I don't think anyone should care if the gold price drops down below $1,800 or whatever. I mean, it's completely irrelevant. The answer is that you hold gold not as an investment, but basically to get the hell out of credit. And that's the way you should look at it, really.
Yeah. No, absolutely. Alasdair, lots to follow up on what you said. A fantastic commentary there, yet again. A couple of things I've noted down and wanted to follow up with you is the divergence of investment, and I think it has to do with optimism, is a lot of money flowing into TLT, that's an ETF tracking the 20-year Treasury bonds, and lack of investment into GLD right now, and that's the gold-backed ETF. Right? Can you elaborate on that? Because it sort of fits in what you just mentioned, I think, is what we're seeing. The optimism that the market is doing fine. We're seeing that scenario play out. Nobody's fearing the recession. Even the Fed said there's no recession. We'll have a very soft landing, if at all. Right? I think that plays into that. But it's just like the last hurrah before the big crash, it feels like, based on also what you just mentioned.
Yeah. It's an interesting point. I mean, I think we've covered the poor sentiment in the gold market, to which I would add, actually, that a lot of this sentiment is driven by the vested interests of the bullion banks, who are desperate to get their books square before the situation deteriorates. Because, I mean, they know that the banking system is facing huge difficulties. They know better than any of us that, there's a collateral crisis and all the rest of it. They can see where this is leading. So on that basis, they need to get their books, and certainly in the paper market, as square as they possibly can, or even net long if they can possibly achieve it. And so this is why they bash it. And, they tell us that, you don't want to hold gold. They're trying to scare everybody out. Sell us your futures. Sell us your forward contracts. We're here to help. That's what
we're here to help.
So I think that deals with the gold story. I think the 20-year U.S. Treasury is interesting because, again, I think it plays into particularly domestic demand. Domestic U.S. demand. I mean, if you're an American and you're seeing the situation deteriorating, you're probably buying into the sort of market expectation that interest rates and bond yields are not going to rise much more. So what do? You go and lock it in. You go and buy your 20-year U.S. Treasury or a fund which represents long bonds of some sort to, just lock in those yields, because if interest rates are going to fall next year, you're not going to get that opportunity again. So you can see the argument. But of course, another thing which I think is terribly important to understand is that when you do get a crisis, the people who are very often the last to see the crisis in the currency are the users of the currency, domestic users of the currency. So, the average American and American fund manager won't see this coming. But you've got to be in a foreigner's shoes to understand the dynamics behind whether you buy or sell dollars. And if you're already up to your neck in dollar credit, do you want any more? When you see falling financial asset values, which are inevitably the consequence of rising bond yields, what do? Do you hold on to your, high-tech stock? Do you hold on to whatever it is? No, you say, my God, these are going to go down because the conditions are no longer a bull market. We've just got to get out. And when you've got something like 14.5 trillion in US equities as foreigners, you might not quite know at this stage what to do with the dollars, but you certainly don't want to be locked into a bear market. So you turn seller. And I think the interesting thing is that both China and Japan, at the government level, have been reducing their exposure for different reasons, I guess, to US treasuries. I mean, I think they've sold down by something like $700 billion worth over the last year, 18 months. I can see that as a trend which is likely to continue. And again, that's likely to drive up interest rates because, the Fed can't necessarily tell us you will buy US treasuries at a certain yield. We're going to put in yield curve control to make you do it. They can do that to an extent, but when the foreigners start selling, that will not work. It really will not. And I would say that one thing which will become apparent in the coming months is that the Fed has actually lost control of interest rates totally. I think it's a very important point for people to try and understand, and particularly resident US citizens who don't look at it from a foreigner's perspective. You've got to step into someone else's shoes to try and understand what drives their decision making. And with foreigners owning so much, as I said earlier, 32 trillion onshore, about another. I mean, if you take the offshore stuff as well, we're looking at an overhang of dollar credit, both long-term and short-term, of about $135 trillion. I mean, this is an unimaginable sum. And it's not going to take very much of that to be unwound at the margin to really impact the US financial scene first and dollars secondly. But as I say, the dollar is going to start going down when people realize that, this isn't just a question of rising bond yields and therefore, attractive and you should hold dollars or you should buy dollars in order to benefit from the from the rising bond yields. It will happen when we get to the point when everybody turns around and says, my God, we've got a crisis here and we've got to get out of credit. And that's the key thing. And the way you get out of credit is you buy gold, which is legal money, real money, no counterparty risk, and you sleep at night.
Fantastic. And on that bombshell, Alasdair, might as well wrap it up here. That was a fantastic closing comment. I think we touched on it all. Like on most of the bullet points I've sort of wanted to discuss with you, the implications of rising bond yields. You mentioned that. You brought in the foreign investors that I wanted to reach out to. The only thing we haven't talked to, and I had an excellent conversation with Michael Howell about that, is overall liquidity in the markets as well, and the flow of liquidity, global flows of liquidity. Because what you mentioned is like once you see divestments of U.S. bond yield, like of the U.S. treasuries and bonds by foreign investors, what Michael Howell sort of argues is that foreign investors really don't have a choice but to invest in the U.S. because it's the only really liquid market that they can bank in, right? Yeah. So, do you see that changing the role of the U.S. in the overall banking system? Maybe as a last question there as well, because that would change the world order dramatically.
Yeah, I'm not sure that I know who is it Martin Howell?
Michael Howell. I'll send you the link to it. It's fantastic. Cross-border capital.
Is he? He's an American?
No, Brit. He's British.
He's a Brit.
Yeah.
Oh well, he's part of the Western Alliance. Okay. What China plans is massive investment throughout Asia, throughout Africa, and also in Latin America. Now, that is something which is obviously going to take a little time to do, and it involves China moving its focus from its export markets as manufacturer of increasingly sophisticated kit, let's face it, to investing in infrastructure around the areas which will provide her for her very long-term future. So there will be a massive investment program. And the idea that America is the only place you can invest in any great quantity will effectively disappear. I think that in the short term, what matters more than sort of allocating funds into America and all the rest of it is the crisis situation which we have been discussing. I don't think anyone outside America, with the exception of a few Brits maybe, I don't think anyone really would want to increase their investment into financial markets, into commercial real estate, into manufacturing at this stage of the entire monetary and economic cycle. So I don't really buy into the idea that all this investment is overhanging the markets and it's going to go in towards America and not China. I think the argument is wrong on two bases. The first is that the timing is just, everybody's, I think, sitting on their hands. That's the first thing, particularly with contracting bank credit. And the second thing is that China has plans, and we'll have to see how that progresses. And I think the world, in terms of international investment flows, will also be looking at that, because there are going to be huge opportunities for a lot of Western construction businesses, heavy engineering, electrical engineering, railroads, building, the whole thing. There are going to be huge opportunities, and I think that's where the investment really is going to go. But the world could well be a very, very changed place with fiat currencies looking like they're being destroyed. And I mean, this could actually happen quite rapidly. The quicker that U.S. bond yields rise, the quicker that's going to bring on a banking crisis. It's going to bring on a bear market with all the knock-on effects of that. You've got the collateral crisis, which I've just mentioned, which I think is very much a hidden crisis. And of course, nobody really understands that the foreign investment in the US is only just a small part of the complete dollar credit story. I mean, I wrote in an article for Goldmoney that this is the unseen elephant in the room, and I think that's probably right.
Fantastic. Alasdair, tremendously enjoyed our conversation as always. Can't wait for the next episode again with you and to see where we're at. Hopefully, like it's not as dire as we discussed here, but I tend to agree. It's like, where's this all heading, right? And this is like the last breakdown in gold, and
Yeah.
But as you said, prices are irrelevant at this point because the trend is upward. So fantastic. Alasdair, where can we find more of you?
Goldmoney.com. I'm head of research there, and basically we store gold, silver, platinum group metals for people who want it stored in secure vaults around the world, and we provide that facility. And also we have a dealing service in precious metals as well. So that's where I am. That's what I do.
Fantastic. Awesome. Alasdair, again, tremendously appreciate your time. We'll have to do this again, maybe wrap up of the year conversation here later in December maybe as well, and try to do some forecasting of what 2024 might bring as well. Thank you so much. And everybody else, thank you so much for tuning in. I hope you tremendously enjoyed this conversation just as I did. If you did, leave a comment, leave a like, engage with us, and don't forget to subscribe to the channel. It helps us tremendously bring Alasdair back more frequently, bring other great guests of great caliber on this program as well. Thank you so much for tuning in, and we'll be back with lots more. Thank you.